welcome to Global Mantra Outlook 2014. And we're back with another season of this show, quizzing top global market speakers on their outlook for the year 2014. Joining me on the show today is none other than Russell Napier, who's consultant strategist at CLSA. Russell, it's great to have you on the show.
Good to
and
be
it's
here.
good to meet you in person as well. I'll begin by asking you, I'm in fact taking a bit from your report in September, where you stated that rising treasury yields, falling inflation, contracting credit and high equity valuations are a dangerous combination. Just based on that analysis, what are we bracing ourselves for in 2014?
I think we're bracing ourselves for the word deflation. It's an important word. It doesn't happen often. It certainly hasn't happened often in the modern age. But when it has come along, it's been incredibly dangerous for the owners of equities. The reason why it's been so bad for equity owners is we often call them assets. But equity is the fine sliver of hope between assets and liabilities. And when you get deflation, you begin to undermine corporate cash flows at a time when corporate expenses might be staying high. So we raised this issue of the very survivability of equity when we raised the word deflation. Now, Mario Draghi very kindly also raised the word in the week just past. And if we look around the world, I can see 2 or 3 big themes for deflation in 2014. It's never been a good word for equity investors. And I think that applies just as much to America, despite the fact the market keeps going up, as it does to other markets in the world.
But right now, the buzzword is really tapering and how that event plays out in 2014. So the big talk is, will the Fed go ahead with tapering? Won't they go ahead with tapering? And if so, when? So, how do you kind of rationalize what happens on quantitative easing and when, the Fed actually press the brakes on that?
As I'm a deflationist, I clearly believe that there will be no tapering and that they will continue this into next year. But at some stage, the market says, do we like the medicine or do we realize the medicine doesn't work? And if they realize this particular type of medicine doesn't work to reduce growth and inflation, then there's very significant downside for the market.
Well, and that brings me to the point that you've been talking about the S&P 500 correcting. You spoke about a fall of almost 70%, but the S&P 500 is closing into record highs. Taking your view on how things will shape up on the macro side, do you expect 2014 also to be a good year for the U.S. economy, for the U.S. markets, or is there going to be a fall?
No, I strongly believe there's going to be a fall. And as I said, I think the market has benefited from inflation coming from 4%, where it was a risk that the central bank would have to tighten to 1%. And that's what's happened in the 2 years you mentioned. From September 2011 to today, inflation has come down, and that's benefited the market. But from where we are today, either inflation is going to go up towards 4%, which would be good for the market. I don't think people will begin to get too worried about the market or inflation roaring through 4%, or it's going to come down, in which case the market is very clearly going to come down.
But here's my question. I mean, if this is being touted as a liquidity-driven rally, which has been ignoring a market, market fundamentals, the state of the economy, then why can't we see the markets rally up from here if you are expecting QE to continue through 2014?
Sure. Well, there has to be some relationship between the valuation and the fundamentals. There has to be some relation ultimately. And if we were only at average valuation levels, then you could say there's certainly plenty of room for more liquidity to push up the valuation. But if we see the fundamentals beginning to decline, which I think is what's going to happen. I mean, we're already getting earnings being revised, earnings growth being revised downwards. We're looking at a banking system which is contracting. We're looking at a baby boom generation, which I think the flow of funds statistics suggest is still de-gearing. We're looking at falling consumer confidence. I mean, if these fundamental things are not affected by 5 years of quantitative easing, then at some stage people question whether it can actually influence the fundamental at all. And that's when the valuation, I think, is very susceptible.
You don't expect the earnings cycle to pick up in 2014? You do not think that there would be a revival in growth? Fine. I mean, 2013, the expectation is broadly sub 2%. But for 2014, many expect it to be really a turnaround year. As corporate balance sheets clean up, deleverage, there's going to be a push on investment, which is what the government wants. And that would be a trigger for growth to recover, particularly in the second half of 2014. Is that not an expectation that can perhaps drive markets higher? I'm just giving you the contra view on what you're saying.
No, absolutely. I mean, of course, I could be wrong, and these things might begin to happen. The corporate balance sheet has been in good condition for really some years now. In fact, it's been the greatest conundrum of this recovery The greatest thing about it has been, why on earth is all this money sticking in the corporate balance sheet? But there must be a fundamental reason why we see so limited investment in this recovery. And it's back to that old word again, it's deflation, it's overcapacity. Now that overcapacity may be in America, but it's more likely to be in Europe, it's certainly likely to be in China. And I think the thing that fundamentally holds corporations back from investing is they look around the world and in most spheres they see overcapacity. So in that environment, I think it's unlikely that you see a pickup. I realize there are many people getting excited about this. And then the second part of the economy, of course, that could pick up is the consumer. But I see exactly the reverse happening. We're not looking at great personal income growth. We're looking at balance sheets still in something of a mess. And we're looking at this demographic function. So if the consumer continues to consolidate, which is reasonable, moderate growth, but nothing spectacular.
But you're also talking about a possible recession in the US, which is really not the common opinion right now. Yes, growth may not go up from here, but market opinion is more tilted towards about 1.5% to 2% growth.
Sure. I mean, I think that's the right place for the market to be. And what I'm saying is there's a greater risk of a recession than most people consider. Because
what's the probability of a recession that you ascribe right now?
Well, I would certainly put it as high as a third. Okay. Because we are at a very dangerous tipping point, which is there is no sign of inflation coming back into America and real rates of interest are going up. Global growth is slowing. Even the IMF is downgrading its global growth forecast, and America is importing deflation. This is all about balance sheets. See, there's far too much focus in America at the minute on consumption. We've got to look at balance sheets. They were in a mess. They are in a mess. And given the demographics, they're in a real mess. And I see if we continue this shift to fix the balance sheets, we're simply not going to get this growth coming back that everybody thinks. And with inflation so low and final demand really moderate at best, and even the last third quarter GDP figures showed moderate final demand growth, it's not that difficult to see us tipping over and rolling the other way. And I guess one question to everybody who's really enthusiastic about the US economy, if things are going so well, why are the banks lending less money now than they were in May?
So if you were to kind of just step back and give your broad view on the US economy for 2014, you're bearish?
Yes, absolutely, sir. I mean, in the business that I'm in, which is really calling stock markets more so than economies, it's where you are relative to consensus. Is the consensus too optimistic? Is it too pessimistic? And I think it's getting definitely too optimistic about the outlook for the US. I can see why everybody wants to be optimistic. Clearly, with valuations at this height, you're really going to need something to pick up in terms of the economy. But I mean, just in that relationship, it is worthwhile reminding ourselves that corporate profits as a percentage of GDP in America are at an all-time high. I mean, we have the series, I think, from 1929, and they've never been higher as a percentage of GDP. So it's certainly possible that even the GDP picks up, corporate profits don't. This is a very mean reverting series. Now, there are lots of people saying, oh, this time is different. It won't mean revert this time. But to buy into corporations at a peak the record high level for corporate profits as a percentage of GDP does seem to be risky, to put it mildly.
What about Europe? Because the markets over there have been a surprise this year. The way they've rallied. Germany, second year, Germany's pretty much mirrored the US market. So 2012, 2013, both years have been great for Germany. But for the rest of Europe also, this has been a great year. Are you buying into the optimism there, or do you think that the problem still persists? Because then you suddenly have an S&P coming and slapping a downgrade in France, and you wonder, what is the optimism all about?
No, there's much less reason to be optimistic on Europe. I mean, I know why people are getting optimistic, because there's no crisis. We sort of live in a world that if it's not a crisis, it must be good. Well, that's not true. If it's not a crisis, it can still be bad, but just not a crisis. Having said that, I think there's another crisis developing in Europe. I maybe put undue strength on these bank balance sheet numbers, but the contraction in bank balance sheets in Europe in terms of lending to the private sector is far surpassing anything we saw in 2009. If we were just looking at the data for the last 10 years of the euro, you would say that the European economy is probably in worse condition today than it was in 2009. Now, the headline figures don't show that. That means we're not in a crisis. But it's very difficult to believe that we have a private sector recovery going on in Europe at a time when credit to that part of the economy is contracting. And that will just be exacerbated this year as these bank stress tests go further and as regulation comes more onto the banking system. So growth is okay, but that's because the public sector is taking over. It's the public sector, particularly in Southern Europe, which is sucking up the credit. And there are some benefits to us investing in private sector assets, i.e. equities, from a good public sector. But ultimately, we need a recovery in the private sector. And it's actually, I would say, further away in Europe today than it was even a couple of years ago. And in terms of the so-called crisis coming back, that will be politics. It's pretty clear that the European election is always a protest to vote for voters. They always see it as a vote without consequences. And we're building up for some fairly nasty protest votes across Europe. And the protest votes will be against Europe and against the euro. And we can see that already in the polls in France. So for those who speculate about the end of the euro, and there are always people who will do it, it will never end for economic reasons, but it could end for political reasons. And I think as 2014 progresses, those political reasons will come very much to the fore.
So you think we should be bracing ourselves for a sharp correction in European equities as well?
Yes, absolutely.
How are you looking at the entire emerging market universe in 2014? Some of the EM fund managers spoke about the good EMs and the bad EMs. And there was an opinion building on how the bad EMs, which are actually working hard to correct their problems, whether it's on the reform side or the deficit side, would be entering into a value zone come 2014. And, investors globally would be very excited about those kind of emerging markets. Is that your view too?
Well, I definitely draw a line between good EM and bad EM, but I draw it in a slightly different place. I don't draw it based on sort of micro or macro reforms domestically. I draw it on the foreign currency debt to GDP ratio. And the reason I draw it there is that sort of can hold a gun to your head. Whatever you might want to achieve in terms of domestic reforms, if that's out of kilter, you don't get the option. You don't get the time. You don't get the opportunity to do these things. Now, India very clearly is not in that situation. I mean, that's worth saying straight up front, that foreign currency debt to GDP ratio to India is about 20%. That's a level which is manageable. So if we live in a world, and it does look like we'll live in a world where capital is ceasing to flow in such great amount to emerging markets, may even be coming back, if you begin this process with far too much foreign currency debt, then there's a real prospect you go bankrupt, which is the Asian economic crisis of 1998. That is not where India is. But there are places, particularly in Eastern Europe and Turkey, where that's exactly where they are. And therefore the so-called bad markets, I would put them there. I think it doesn't really matter now how much Hungary wants to reform. Its foreign currency debt to GDP ratio is too high. Having said that, just because some of them are bad doesn't mean to say that the ones that are good benefit. The ones that are good still have to struggle. That's the nature of an economic cycle. India's in a down cycle at the minute. It will continue to be next year. But the crucial thing is there will come a point at which it's a buy. There will come a point short of default, which is what's going to happen in some other EMs, where valuations get to a level where we can look to put it into India. And as you say, the reforms slowly, and I know far too slowly for most Indians, the reforms slowly progress. 2 steps forward.
But the markets are at record levels in India.
2 steps forward, 1 step back. They are at record levels. That's why I wouldn't want to buy it. I mean, I've written a piece a few years ago being very, very bullish about India in the long run as the one emerging market which will probably emerge. And I've never owned an equity in India because the equities are too expensive. As a macro strategist, I should be telling you how important it is to look at the economy, and that will tell you how much money you make in stocks. Well, it isn't. What's important is the value you pay. And one day, the Indian equities will be cheap enough to buy, but it's certainly not yet.
But if I were to ask you, which are your top 3 emerging markets stepping into the new year, which would those be?
Well, I wouldn't have any if I wanted to make any money. I mean, I really think it's going to be a pretty terrible year for emerging markets next year. So I would completely avoid them if I had the possibility to avoid them.
Are you optimistic about Japan in 2014?
I think the crucial thing to remember about Japan is they will just keep coming back over and over and doing more and more. There is really no alternative for them, and I think that is crucially different from the rest of the developed world. It is said that the Japanese are in the business of extending the central bank balance sheet to create money and create inflation, but that's not correct. That's what the Federal Reserve is doing. The Bank of Japan is in the business of buying government debt because nobody else will. And that's a different thing because there's no easy way to get out of that, and you have to keep coming back again and again and again. So I'm sure that eventually they will succeed with inflation, but more crucially than that for the rest of us is what will happen to the yen as they continue with this process, and it's got a lot further to fall. And once again, I believe that is a deflationary win. So within Japan, yes, the creation of that money, or the attempt to create that money, good for Japanese equities, but the fall of the yen can really wreak havoc, and we've only seen stage 1 in the decline of the yen.
Talking about India now specifically, and I know you've said that you like India compared to other emerging markets, but how do you look at the election event in India?
Well, the election event in India is crucial to the extent that it plays in the attracting of capital to India. We're looking at a whole emerging market sphere now where there's going to be a lack of capital inflows. We may even see capital outflows. And for India in particular, with a reasonably large current account deficit, that's a particular problem. So that's going to be a problem India will face whatever happens in the election. Now, it can only get worse if something happens in the election where we have a coalition in power which is inherently inimical to foreign capital or frightens local capital. And people forget sometimes that local capital is actually more important than foreign capital. And local capital leaves through all the various ways that it can leave. Then things get a lot worse. So the important thing for India is to have a government which is no worse at attracting capital than the last one. And it would be wonderful if it was a government which was even better at attracting capital, but it must be no worse, because it's going to be a tough year for every emerging market next year in trying to bring in foreign capital.
In an environment where the expectation is that the CAD will narrow, shouldn't one be looking at India favorably right now?
Well, no, because it may be narrowing because of lower growth. I mean, most countries out there in the emerging markets are going to have much smaller current account deficits next year. I mean, look at Greece. It's gone from Greece, Spain and Southern Europe, gone from huge deficits into balance or surplus. It didn't happen in a positive way for the economy. So I think it's right to see current account deficits getting smaller, but if it happens through lower growth, it's the most likely way it happens. That's the way it usually happens. I mean, I can't see there being a great export boom to have a major positive effect on the current account next year.
Okay, and what about growth in India? Do you think that's going to come back, or there's going to be
the whole
pressure?
emerging markets will continue to disappoint. I suspect the numbers are already worse than people think they are. If you look at some of the corporate profits coming out of people doing business in emerging markets, they're really being very disappointing. Some of that's exchange rate orientated, but I think there's a little bit of it on final demand. So, emerging market cycles are fairly easy. When they manipulate your exchange rate, you get a great big liquidity boom. You rise to uncompetitive, you get a very large deficit, and then the whole thing has to correct back into a different stage of the cycle. And if we look at where current account deficits are, we're just at the beginning of that readjustment process. So that readjustment process primarily comes from lower growth and not an export boom. So we're starting the process. We haven't finished it. We're not even halfway yet.
So how do you look at the rate hikes in India? Because there is need for growth, but right now the focus is on inflation.
If you take a currency policy that has direct impacts on your interest rate policy, and this is where India, I think, has benefits. It didn't in the great boom from 2009 to, let's say, to 2012, when everybody else was monetizing huge amounts of capital inflows. I think India let the currency be more flexible than other people. Now, that's not to say let it become entirely flexible. There was still a little bit of meddling going on. But now I think the central bank can reap the benefits of that. And that is, it can let the currency go down. It doesn't have to keep raising rates to protect the currency. And I realize that's been part of what's been going on. But as we see the mess in emerging markets developing next year, there is an option for India to go forward without jacking interest rates up and allowing the currency to take some of the strain, particularly if we lived in a global disinflationary or deflationary world, because I do understand that the key issue for India with its exchange rate is the domestic inflation it can bring. So if we lived in a world where global inflation was falling fairly rapidly, then I do think India might adjust more through its exchange rate, and therefore the need to raise rates would be a bit less than people think it is.
So you do not expect more rate hikes into 2014? Do you think they
No,
will
I
be
don't
more
think
hikes?
rates will go up, and I think the exchange rate will be allowed to take the strain, and I think that's a good thing. I mean, I do know there are some bad things associated with it, but on the whole, it's a much better way to adjust than the alternative, which is to have to defend an exchange rate, because if it goes, you're bankrupt. India's not in that situation, and that should be seen as a positive, not necessarily for investors, particularly for foreign investors who will lose money on the exchange rate, but for the adaptability, for the ability of for a currency and an economy to adapt, this is a good thing. Flexibility is a good thing.
And what about 4 to 5% growth in India? If that's the kind of number that comes out, do you think that as somebody who watches the market from a distance within EMs, that's fair?
I think that's too high. I mean, it's really going to be a very tough year for all emerging markets next year. I mean, I should say there's a little technical issue.
So there are
here,
going to be more growth downgrades, you think?
Well, yeah, absolutely. And I think it sounds like a technical issue, but it's very important. In previous eras, when we funded emerging markets, we funded them primarily through bank lending. Bank lending tends to have a reasonable tenor. It takes a long time to extract bank lending for an economy. But this time we funded them through open-ended bond funds. Now, if the mess is really in Eastern Europe, and I think it is, and they begin to get redemptions in these bond funds, they simply will not be able to extract the capital from Eastern Europe. The bonds they bought are entirely illiquid. Not only that, Christine Lagarde has endorsed the use of exchange controls to prevent the redemptions of these funds. And therefore, it may be that someone who manages that money, even though he is fairly sanguine about the outlook for India, finds himself having to pull this capital out of India because something's gone wrong in Poland. Now, it sounds like it's something from science fiction, but we're very good in finance at creating things that sound like they're from science fiction. So I think this is why it's a global EM problem. The contagion effect this time because we've provided capital to EM in what are theoretically short-term liquid assets. The contagion this time can be really very rapid, and I think we've seen it a little bit in the second quarter of this year. I think that was just a little tremor, just a foretaste of what's to come.
So, as we wrap up the interview, you sound very bearish about 2014. But in that bearish view, do you think that there are opportunities to make money?
Well, you say that, but as a financial historian, I can give you lots of periods where you lost money in all the asset classes, or virtually all the asset classes. So I like to look at.
Will it just mean that there'll be higher cash levels? Do we expect cash to be king in 2014?
I certainly expect cash to be king in 2014.
Is gold going to be a bet for 2014?
In terms of gold, I think I would say, as a financial historian, you just have to watch it. If we start getting the bad news that I'm looking at, and that is really particularly bad news, and gold starts to go up, then it is a buy. It is going to be a safe haven, because what that's telling you is if we roll over into a deflationary world, you're going to make money in gold. And I know that if we go to an inflationary world, it's highly likely you'll make money in gold. So it becomes a buy asset, but it's too early to buy it at a time when I think real interest rates are going up. But the day that it starts going up on bad news is a day when investors will find a safe haven in gold.
So you're more cautious about 2014 than 2013?
Absolutely. I was very cautious in 2013, which proved to be right for emerging markets, very, very wrong for the United States of America. I think there's reason to be much more cautious about 2014.
All right, Russell, really good at that. Thanks very much for taking out the time and speaking with us. Well, with that, we come to the end of this edition of Global Mantra Outlook 2014. Catch you with another guest next week.
We've been delayed in building the requisite infrastructure required. So hopefully, after the election, the new government, whichever it is, whichever party, will start to make this a priority. Or you set up in India some kind of guarantee bank, guaranteed by the government, issued by the government, and the guarantee bank, whatever you want to call it, guarantees parts of these projects. So the government of India comes and says, okay, look, this bridge, we don't own the bridge, we don't want to own the bridge, we want to privatize this thing, but we'll guarantee 50% of the principal, we guarantee 60% of the principal, right? Then the credit rating of that bridge or that project will be higher. If the rating is higher, the cost of that project is lower. So be creative. Don't just say, we want to build a bridge, foreign money, where are you?